What if I told you that retirement, the golden promise that keeps millions of people chained to jobs they hate, was never designed to set you free? What if the entire system was engineered, not as a reward for your decades of labor, but as the largest wealth transfer mechanism in modern history? And you are on the losing side? Here's the thing they don't want you to connect. In 1980, over 80% of American workers with pensions had defined benefit plans, meaning your employer guaranteed you a specific monthly income for life after retirement. You didn't have to gamble. You didn't have to become an amateur stock picker. You just retired. Today, that number has collapsed to less than 15%. And in its place, we got the 401k, a system that sounds like freedom but functions like a trap. You're told it's your fault if the market crashes the year you retire. Your fault if fees eat 30% of your lifetime gains. Your fault if you didn't diversify correctly while working 50-hour weeks. But what if none of this was accidental? Before we go further, drop a comment and let me know. Where are you watching from, and do you even have a retirement account? Because this story impacts every single one of us, and the unfiltered truth is only found here. Hit that subscribe button if you're ready to see how deep this goes. Let's rewind to 1978, the year they changed everything. In 1978, Congress passed the Revenue Act. Nobody thought it would replace the entire pension system, but then something happened. Corporations realized they'd been handed a gift, a legal way to eliminate their pension obligations entirely and shift all the risk onto workers. See, traditional pensions were expensive. Companies had to fund them. They had to manage the investments. And if the market crashed or the company made bad bets, the employer still owed you that monthly check. It was a legal liability on the corporate balance sheet, sometimes billions of dollars. But the 401k, that's your problem now. The company contributes a little, maybe 3%, maybe 6% if you're lucky, and then they're off the hook. If the market crashes, if fees devour your savings, if you panic sell during a recession, that's on you. The corporation's liability? Gone. Sound familiar? This is exactly what happened with healthcare. Employer-sponsored health insurance used to mean something: comprehensive coverage, low out-of-pocket costs. Now it's high deductible plans that leave you with thousands in medical debt even though you reinsured. The risk got transferred. The language stayed the same. By the mid-1980s, corporate America had a new playbook. Freeze the pension, offer a 401k match, and call it an upgrade. Workers were told they were being given control and flexibility. What they were untold was that they were now responsible for making decades of perfect investment decisions in a market designed to extract fees at every turn. Let's talk about those fees. The average 401k has an expense ratio between 0.5% and 2% per year. Sounds small, right? But over 40 years, a 1% annual fee can reduce your final retirement balance by 28%. That is not a rounding error. That is hundreds of thousands of dollars siphoned off by fund managers, brokers, and financial advisors you never even met. Sound familiar? It's the same model as student loans. You're told education is an investment in yourself, so you take on debt with interest rates that compound faster than your starting salary can handle. And here's the kicker. When the market crashes 2000, 2008, 2020, your 401k gets obliterated. But do the fund managers lose money? Do the banks collapse? No, they get bailed out. The Federal Reserve steps in. Interest rates drop. Quantitative easing floods the system. And within a few years, Wall Street is back to record profits. But you lost 40% of your retirement savings, and you're 5 years closer to retirement age with no way to make it back. Sound familiar? Because this is the exact structure of the 2008 housing collapse. Banks made reckless bets with mortgage-backed securities, crashed the global economy, and got rescued with taxpayer money. Homeowners lost everything. The risk was socialized. The profit was privatized. The 401k is the same con, just slower. You're the bag holder. You're the systemic shock absorber. Every time the market gets too volatile, your retirement account is the collateral that gets sacrificed to stabilize the system. And it's accelerating. In 1980, the total value of assets in defined contribution plans like 401ks was around $500 billion. Today, it's over $7 trillion. That's trillion with a T. $7 trillion of worker savings now locked into the stock market, creating a permanent demand for equities regardless of valuation. This isn't retirement planning. This is systemic risk transfer at a scale never seen before in history. And the people who engineered it? They knew exactly what they were doing. So who actually wrote Section 401k? The architect wasn't a politician. It was a benefits consultant named Ted Benna. In 1980, Benna was working for a client trying to design a retirement plan. He pitched it as a replacement for pensions. Benna later said he thought it would be a supplement, not a substitute. But corporations didn't care about his intentions. They saw an escape hatch from pension liability and ran through it. By 1982, the IRS officially blessed the 401k structure. By 1984, Congress passed laws making it easier to roll out. And by the 1990s, pensions were disappearing faster than factory jobs. But here's where it gets darker. The explosion of 401k adoption didn't just happen because companies wanted to save money. It happened because Wall Street needed it to happen. Think about the timing. The 1980s saw the rise of institutional investors' mutual funds, index funds, hedge funds. These entities needed a massive, stable inflow of capital to manage. Pensions were managed in-house by corporations or via a few large pension funds. The money wasn't flowing through the broader financial system. But 401ks? Those are managed by Fidelity, Vanguard, BlackRock. Every paycheck, millions of workers automatically deposit money into funds that charge fees, generate trading volume, and create liquidity for Wall Street. It's a captive market. You can't opt out, not really. Social Security is underfunded and pays a fraction of what you need. Pensions are gone. So you're forced into the 401k system, which means you're forced to feed Wall Street. And when the market crashes and your account loses half its value, Wall Street doesn't lose. They still collect fees. They still get bailout. They still pay bonuses. The real question isn't how retirement became a financial trap. The real question is, who benefits when 150 million Americans have no choice but to gamble their futures on a rigged market? You won't believe the scale of the returns they're extracting. Let's break down exactly how this trap functions, because once you see the mechanics, you can't unsee them. Mechanism 1. The illusion of choice. You're told the 401k gives you control. You get to pick your funds. You get to decide your asset allocation. You're an empowered investor. But here's what they don't tell you. The menu of investment options in your 401k is curated by your employer and the plan administrator. You're not choosing from the entire market. You're choosing from 10 to 20 pre-selected funds, most of which have expense ratios between 0.5% and 1.5%. Compare that to the total stock market index funds available outside of 401k, some of which charge as low as 0.03%. But those aren't in your plan. Why? Because your employer's plan provider has agreements with fund companies. They get paid to offer certain funds. You think you're investing. You're actually being marketed to. And the average worker? They have no idea. A 2022 study found that 67% of Americans don't know what an expense ratio is. They don't know they're being charged. They don't know that over 40 years, a 1% fee difference can cost them $250,000 on a $500,000 balance. This is financial illiteracy by design. The system is complex enough that you need an advisor, but the advisor is paid by the same companies managing your money. It's a closed loop of extraction. Mechanism 2. The forced march into equities. Here's a stat that should terrify you. As of 2024, approximately $10 trillion of the $35 trillion in U.S. retirement accounts is held in employer-sponsored defined contribution plans like 401ks. That means $10 trillion in worker savings is structurally locked into the stock and bond markets. This creates moral hazard on a civilization-ending scale. When your retirement depends on the S&P 500 going up, the government has no choice but to prop up the market at all costs. If the market crashes and stays down, 100 million Americans don't retire. They can't. They keep working into their 70s, or they retire into poverty. So what does the Federal Reserve do every time there's a crisis? 2008, drop rates to zero. Print $4 trillion. 2020, drop rates to zero again. Print another $5 trillion. They have to. Because if they don't, your 401k implodes, and the entire social contract collapses. But here's the sick part. This bailout mentality doesn't protect you. It protects the market structure. The banks get liquid. Asset prices stabilize. But you, the individual worker who panicked and sold at the bottom, you're still screwed. The system survives. You don't. Mechanism 3. The fee extraction engine. Let's talk numbers. The average 401k balance for Americans aged 60 to 69 is around $200,000. Sounds decent, right? Now let's run the math on what was stolen. Assume you contributed $500 a month for 40 years with a 6% employer match. Assume a 7% average annual return, the historical average for a balanced portfolio. Your ending balance should be around $1.4 million. But with a 1% annual fee, your actual balance is closer to $1 million. That's $400,000 gone. Not lost to market crashes, not lost to bad luck. Extracted as fees. And if your plan has a 1.5% fee, which many do, you're down to $850,000. Over $500,000 gone. Where did it go? to fund managers, to plan administrators, to the financial advisors you never asked for, to the compliance costs and legal structures that make the whole system deliberately opaque. This isn't a bug, it's the core business model. And it scales. If $10 trillion is in 401k style plans, and the average fee is 1%, that's $100 billion per year in pure extraction. Every year. Forever. No wonder Wall Street fought so hard to kill pensions. Mechanism 4. The sequence of returns risk. Here's the nightmare scenario they don't warn you about. You spend 40 years building your 401k. You're 64 years old. Your balance is $800,000. You're planning to retire at 65. Then the market crashes. 2008 style. Your balance drops to $480,000. You're 1 year from retirement. You can't wait 10 years for it to recover. You need that money now. So you retire into poverty or you keep working. This is called sequence of returns risk, and it's the silent killer of the 401k system. With a pension, this didn't matter. The market could crash the year you retired, and you still got your $3,000 month check. The company bore the risk. But now, the market's timing is everything. If you're lucky and retire into a bull market, you're fine. If you're unlucky and retire into a crash, your life is ruined. It's a lottery. And 150 million Americans are forced to play. Mechanism 5. The captive investor problem. Here's the most insidious part. Because your retirement is now tied to the stock market, you have become a structural defender of the system that's exploiting you. When politicians propose a wealth tax, you panic. That'll crash the market. My 401k will tank. When the Fed talks about raising rates to fight inflation, you worry. That'll hurt my portfolio. When there's talk of breaking up monopolies or regulating Wall Street, you hesitate. What about my retirement? You've been turned into a human shield for financial elites. Your interests are now structurally aligned with theirs, not because you're wealthy, but because they've made you dependent on the same asset prices they manipulate. This is the ultimate psychological trap. You're not an investor. You're hostage capital. The 2008 case study. Retirement accounts as systemic shock absorbers. Let's look at what actually happened in 2008. Between October 2007 and March 2009, the S&P 500 dropped 57%. But the banks? They got the TARP bailout. The Fed's balance sheet exploded. By 2010, Goldman Sachs was paying record bonuses. Meanwhile, millions of Americans delayed retirement. Some never retired at all. The median retirement age rose from 62 in 2007 to 65 by 2015. This wasn't a recession. It was a forced labor extension program disguised as a market correction. And it's going to happen again. The system is now more fragile, not less. Total U.S. household debt is $17 trillion. The Fed's balance sheet is still $7 trillion. Corporate debt is at all-time highs. The everything bubble hasn't popped. It's just been reinflated with cheaper money. When it pops again, and it will, your 401k is the collateral. The modern escalation. Target date funds and auto-enrollment. Here's how they're tightening the trap. In the 2000s, the industry introduced target date funds. These automatically shift your allocation from stocks to bonds as you age. Sounds smart, right? But here's the con. Target date funds have higher fees than basic index funds, often 0.5% to 1% more. And they're now the default option in most 401k plans. You're auto-enrolled, you're auto-allocated, you're auto-extracted, and because it's automatic, you never question it. The fees are invisible. The underperformance is hidden. By the time you retire, you've lost $200,000 to a fund structure you didn't even choose. This is parasitic finance at scale. So where does this leave us? The 401k experiment has been running for 45 years. An entire generation has now retired or tried to under this system. And the results are catastrophic. Nearly half of Americans age 55 and older have zero retirement savings. Zero. The median 401k balance for people in their 60s is $200,000, which sounds like a lot until you realize it generates about $800 a month in safe withdrawal income. Combined with Social Security's average $1,800 a month, that's $2,600 a month total. Try living on that. Try paying rent, healthcare, food, and utilities in 2025 on $2,600 a month. This is the system working as designed. You were never meant to retire comfortably. You were meant to work until you couldn't, then survive on scraps while your accumulated savings were drained by fees, inflation, and market crashes. And the people who built this system, they have pensions. Congress has pensions. Corporate executives have deferred compensation and golden parachutes. The 401k wasn't built for them. It was built for you. Here's the final brutal truth. The next collapse will be faster and more devastating because the system is now global and instantaneous. High-frequency trading, algorithmic risk models, derivatives exposure, it's all interconnected. When it breaks, your 401k won't just lose 30%. It could lose 60%. And this time, the Fed might not be able to print fast enough. The lesson here isn't despair. It's awareness. You can't opt out of the system completely, but you can see it for what it is. You can minimize fees. You can diversify outside of Wall Street. You can build skills, relationships, and assets that aren't tied to a collapsing financial structure built on borrowed time. And you can stop pretending this was ever about your retirement. So I'll leave you with this. Are we wiser now, or are we just walking the same path in better suits? Drop your thoughts below. Subscribe if this opened your eyes. And share this with anyone still pretending their 401k is freedom. The truth doesn't care if you're ready.